This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Mikael Krogh of Investigate VC. Mikael, thank you for joining us.
Thank you for inviting.
So what was your background before investing in early stage companies? What did you do before this?
So I've always been on the investor side. I started out in a big fund in Norway being an equity analyst, so investing in more listed companies. And then I've had some operational roles also on in the companies I invested in, but basically been on the investor side all along. Latest, before starting my own VC, was building a corporate VC. That's what brought me to Singapore and Asia.
Oh, great. So what excites you right now?
I think that's a good question. I think we are at the point where so many technologies enable disruption of virtually every industry and all processes of different industries. So there are so many opportunities, more than ever before in history, to start up something that will have the potential to disrupt the industry you're starting up in. And that's incredible. If you and I, we had a business idea over the table now that involves AI and big data analysis, we can have the infrastructure up and running in the matter of 2 minutes to support that idea. If we had the same idea 5 years ago, we need to build up the physical infrastructure before we could build the product. And that is an incredible enabler, just to mention one.
Oh, great. So what's your advice for people that are starting to invest in startups today? What do you tell them to do before they write that check?
Yeah, I think it's probably nothing revolutionary, but if I look at my own portfolio, invested in 9 companies so far, if the common denominator, I'm quite fortunate. They're all doing quite well, but it is because of the founders, nothing else. Of course, the business idea have to have some kind of merit, but I would much rather invest in a company with a bad idea but great founders than a company with the world's greatest idea or product but bad founders. So founders is the foundation of everything. You have to have great founders. And then I have a particular business model perspective or investment theme, not an industry vertical or B2B or anything else like that. So because I think many of the startups today, they jump across industry sectors. So especially when you have early stage focus, it doesn't make too much sense to have an industry focus.
Very good. And so on the other side of the table, how do you advise those founders who are just about ready to launch their startup?
Actually, so if you find the best founders, you don't have to advise them about too much. But I think I learn more from them than I can teach them. But what's important is just finding the product market fit and a go-to-market strategy that's not based on advertisement. As a general rule, I think advertisement doesn't work. So that's also actually a requirement from my side, that I'm looking for founders or companies that has a different go-to-market strategy that acquires the customers outside of just regular advertisement. That's a pure... So Hall, can you mention 2 brands you've seen ads for today? Just 2 brands?
Well, yeah, I saw one for Netflix and I saw one for a car dealer. So
okay.
Very different.
You're actually the first person I've asked this question to that could remember 2 brands that I've seen ads for. But you have seen, it's afternoon, your time now, you've seen many thousand ads as of today. But you could remember 2. That's very impressive. But typically when I ask people, they might remember 1, but many times not even 1 brand name they've seen an ad for. So I think we're very good at just dismissing information today because we have so much of it. And ads, the value of ads today is extremely limited.
Great. Well, let's talk about the state of investing in startups. How do you see the industry evolving and what are the changes you see coming up?
So I think there's, at least here in Southeast Asia, where I'm focused, you see that the regular VC investors, so meaning from Series A or Series B and beyond, has grown tremendously here in Southeast Asia. But early stage VCs have actually lagged behind. So the growth hasn't been that big here in the region. So early stage investments is a little bit more tricky to get than Series B and beyond. So there's like misalignment in the market there. And that's also because of the VCs that started up and maybe was quite a bit more early stage than they are today. They started up and with a smaller fund and got very successful. And hence the fund number two was much larger. And by virtue of the size of the fund, they have much more focus on Series A, B, and beyond. So the seed to Series A is actually lagging behind here in Southeast Asia.
So let's talk about your investment thesis. You referenced it a moment ago that you had a certain way of funding deals, and maybe you can tell us more about that method.
Yeah, so maybe I can start telling why I didn't want to have an industry vertical theme, because I don't know if you and your listeners have heard about it, but I can give you one example. If I had a fintech investment theme, I would not have invested in Uber competitor here in Southeast Asia called Grab. So Grab took over Uber or pushed Uber out of the market here in Southeast Asia. So they were a ride-hailing app, started out as that. And if you were a fintech investor, you wouldn't have invested in them. But today, Grab is now arguably the number one fintech player in the region. You can use it as a payment app, just like WeChat. Everywhere, F&Bs, even in stores, you can use it as a payment app. So it's become the number one fintech, or at least one of the top fintech plays in the region. And you wouldn't, if as an early stage investor, you would never have invested in them if you had a fintech investment team. So I believe that you need a different approach. And I've adopted an approach that was mentioned in Harvard Business Review over a series of articles. That's where I got my framework. So it's a framework that is developed by Open Matters. And they argue that you should rather look at the business model than the industry vertical. And I chose the Network Orchestrator business model, where that's companies that enable its network to do information sharing and transactions within the network and share the value created. Obvious examples are sharing economy, Airbnb, Uber, and Grab, and Gojek here also in Southeast Asia. But it doesn't have to be connecting people and assets, but it typically the companies I've invested in they're more connecting data points and co-creating products that's more for the B2B scene here in Southeast Asia and the world. And that's worked out pretty well. These types of companies, they typically get their product and service up and running quite quickly and get revenue, which is one of my criteria too. I want to see some regular revenue before I invest. And they typically scale very quickly. And co-creation is a very important part of network orchestrator business model companies.
Great. So you see a lot of startups and you see the ones that you're dealing with. What are the challenges or the top one or two challenges most startups face in launching their business? Is it regulatory? Is it the market? Is it technical? What do you think they're struggling with the most?
I think it's the go-to-market strategy. That's where people have or companies have the biggest challenge. It's how to acquire customers in innovative and smart way. Because again, back to we are so overwhelmed by information. Let me also paint a picture a little bit around that. So if we went 20 years back and we approached a business and said, your overall cost is $100. I'm addressing, if you change your supplier, which cost you $5, I can save you 10%. I'll only charge you 4.5 instead of 5. If you have that value proposition 20 years ago, you might have gotten attention. So you can save them 50 cents out of the total $100 of expenses. But today, I would bet you have a hard time approaching any business with that value proposition because people are just so overwhelmed that they can't even think about changing a supplier just to save half a percentage of their cost, total cost. But if you come to them and say, we can maybe save you a few cents, but we can make your life much easier. So we can make your processes easier and so on. That's the only time when you get attention from your customers. So the dynamics today, I think, is quite different. And this is fueled by, we are just overwhelmed by information and things to do. I don't know about you all, but I have actually several thousand unread emails. Hopefully, none of them important, but none of us, I think, feel that we don't get enough information. So if we can help people getting the right information and in an easier way, then you can get attention from the customers. But still, it's super hard to get the attention from the potential customers. So that's the trickiest part, I think, because many have great products or services out there, but it's to get the attention from the potential customers or users.
Well, great. So you see a lot of startups in different sectors and applications. If you have to pick out one or two of those that you think are good immediate opportunities for investors to pursue, which ones would you call out?
So I think actually within that business model, so co-creation. So there are so many businesses today. So if you take S&P 500 companies, if you look at them in 1975, so the value put on those S&P 500 companies, you could find 80% of that value on their balance sheet, tangible assets. Today, it's completely reversed. So the value of the companies today is intangibles, basically, more than 80%. And still, companies out there, they don't, if you go to the CFO of any S&P 500 companies, you would get the answer immediately of what assets they have, what's the value, what's the age. Paul Martin has one laptop and one mobile phone and the age of that and the value of it immediately. But if I ask them, the same CFO, what's your value of your intangibles? That's the most important part. That's more than 80% of your value. What touch points do you have? What network do you have? What's their value? Each touch point. They have no clue. And that's a big opportunity for companies, startups, where they can see what type of, call it network orchestration opportunities are there in these existing businesses, where you can extract more value out of those touch points and maybe add other external data or touch points to create more value. And I can give you an example of this. So you have Tesla, which is very well known for probably all your listeners. If you take the autonomous driving part, so they're just a typical asset builder. So they're building cars and selling it. But when it comes to autonomous driving, they've seen and seized an opportunity to do network orchestration. So they are co-creating the autonomous driving capabilities together with all their customers. And in half the time of Waymo, they are arguably caught up with Waymo's autonomous driving capabilities. And that's because they have, I think by the third quarter last year, they had 15 billion miles on their autonomous driving system, while Waymo had, was it 30 million or miles compared to 15 billion miles. So with this network orchestration approach, you can really make a big impact. So I see that's also, hence my investment theme. But that's where I see a huge opportunity today. So actually, no matter what industry, if you look at what type of networking effect you can get out of the touch points in that industry, and potentially by combining other touch points externally, then you can really make a big impact in any industry.
Well, great. Well, in the last few minutes that we have today, what else should we cover that we haven't?
No, I think it's also interesting. I think one of my startups, which might be known for some of your listeners, which I've invested in, is Antler. And I think it's very interesting, their approach. We've had, if you go 60 years back, plus we had the start of the PE funds. And then we got the VCs that invested in startups. And then we had the development of accelerators that went even earlier than VCs many times. And then you have a startup generator like Antler that actually starts before you even have a company up and running. So they're attracting talents to their 6-month program and co-create these companies with the talent, corporate network, advisors, and capital in the program itself, and co-create over 6 months brand new companies that's making some headways in all types of industries. But I think I'm not here to promote Antler, but it's the technology that enables that approach today. And that's very interesting. And at the same time, they're addressing a few of the biggest failure points: not the right team, not enough capital or funds to drive the company forward, and not the right product market fit. I just think it's very interesting that the value creation is starting earlier and earlier now. So you can also see it with Sequoia. If you came to Sequoia 5-6 years ago and said, I need $500,000 for my startup, they would just say, not interested, come back when you need $5 million. But they've changed the tune, of course, because they see that the value creation is happening earlier and earlier, and that's enabled by new technologies. It's much easier to start something that's disrupting companies. A beautiful example of that was WhatsApp. They never really raised any large quantity of capital, but when they sold the company, there were 50 employees and profitable, and sold it for $19 billion. It's an extreme example, but it's in smaller degree, that's not uncommon to see among the startups today.
Well, that's a good point and a good example. And so I guess to close out, how best for listeners to get back in touch with you?
Well, I think, as you said, you can reach out to me on LinkedIn or my investigatevc.com webpage. And I'm always interested in creating new or expanding my own network. So that's what it's all about. So I think in the notes, you'll find those links.
That's right. We'll include those in the show notes. I want to thank you for joining today and hope to have you back for a follow-up soon.
Great. Thank you all, and have a great afternoon.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.